Hey everybody, this is Mark Kennedy calling from Monorail. Today I'm going to talk to you about my knowledge of when the market's going to crash. Actually, if anybody tells you they know when the market's going to crash, run, because they don't. Nobody knows when the market's going to crash or if it's going to crash. Although what I do know is that about 75% of the time the market is up. About 25% of the time the market's down. It's very unlikely to have a crash every year. They happen around every 4 years on average, historically speaking. If anybody tells you they know that the crash is coming because of this, that reason, or that reason, they don't. You'll only really find out about it, what the reasons were after the fact. Historically speaking, a couple of them that have occurred relatively recently, 2008 was probably the most interesting one. That was a financial markets crash, and it was really caused by an accounting rule change. It used to be that banks would have their mortgage assets on their books at whatever the cost of the mortgage was. Well, some accounting rule decided that they would change that to be marked to the market. Well, these are very illiquid assets, so it was very difficult to mark them to market. And as a result of that, there was a crash in the real estate market. When those assets started to get sold, they were getting sold underwater. What happened in that case is people lost confidence. Think about it. Our economy is almost completely built on confidence. Confidence that if you borrow money from me, I'm confident that you're going to pay it back. If I'm not going to loan you the money. If that doesn't happen, then the economy slows down and stops completely. And that's what happened in 2008. People lost confidence. When money markets started to not guarantee their one-for-one payout ratio, people lost confidence. People started to take money out of those money market funds. So bonds had to be sold. It was one thing after another that caused the financial crisis of 2008. Well, that being said, it's still over more than 100 years. The market's averaged about a 10% return plus dividends over a very, very long period of time. It is the single best investments you can make for your retirement. And you can diversify really quickly. You don't have to buy a lot of different stocks. For example, if you buy the S&P 500, IVV or SPY, you're buying a little bit of every one of the S&P 500 stocks by owning just one ETF, which is an ETF stands for exchange traded funds. So you can diversify easily and you can get your retirement started as soon as possible. So that's all I have to say on that subject. I appreciate your time. That's Mark Kennedy signing out. Keep in touch. We're going to be giving more and more market updates as the time progresses.